Hey everybody, Brian Shannon here from alphatrends.net. Today is Friday, the 27th of October. Let's move this over here so we have room to the right because we're in a lot of charts at the bottom right corner. You can see here it was a brutal week for the markets with the exception here of, what is that, the bonds, and Bitcoin had a really nice week. But the Russell 2000 just 33 basis points off of its low for the year, and the biotechs just 11 basis points. Everything here is for educational purposes only. Trading is risky. There's no guarantees. Be an adult. Just learn to recognize that what this is. This is my opinion of the market, and that's it. So let's get started here with the S&P 500. We were talking a lot about the potential for support at this level of interest from the March low, the anchored volume weighted average price. And we call it a level of interest because, as I always point out, we only know true support after the fact. We can look at that and say, hey, I want to buy there if conditions tell us that we should. What are those conditions? Well, that's when we switch to the shorter term time frame. That's what trend alignment is all about. We look to the 30-minute time frame, and what do we see? We see a market below a declining 5-day moving average with a very clear pattern of these lower highs and these lower lows. So while this is a level of interest at this point, you can see right here at about 412 and a half, it is not a reason to take action. First and foremost, we look at the direction of the 5-day moving average and say, what is the direction? Well, if it's declining, it's still guilty till proven innocent. I can't get bullish on a larger term time frame if I'm still bearish on the shorter term time frame. We only look at potential levels for a bounce. Yesterday, I put this video out where I had mentioned this as a potential bullish scenario, and something like this still may occur, but I'm not locked to any belief about what the market should do. I was very clear to say this is a potential bullish scenario, and there's nothing here to say this will happen. I'm not trying to make a prediction. I'm saying if there's a bullish scenario, this might be it. Let's talk about what the bearish scenario might look like, because if we look at the weekly time frame of the S&P 500, you can see we've got a couple of levels below us. So this is the anchored volume weighted average price from the COVID low. That's that bright green line. The blue one is the anchored VWAP from the first handoff. When we find an important anchor point, it rallies away from there and pulls back and touches it, then rallies again. That's what we call the handoff. That's a chapter in my book. The next handoff occurred on the next touch over here, so we anchor to that point. So we have these three levels that may act as a place where buyers are found, or maybe that just cuts right through them. I don't know, but I know this. I'm not going to look to get bullish until we can at least hold above a flat to rising 5-day moving average. If that occurs next week, it's likely to occur like this. So the market may, let's say it rallies up big on Monday, fails on Tuesday, or let's say it fails on Monday, and then we see a turnaround Tuesday where the market gaps above that 5-day moving average and does this. And then perhaps we're headed for another rally that gets up towards this level, let's say, takes that out, and then most likely a little bit of a pullback, perhaps down towards that 5-day moving average. It's all just a potential scenario. This is what could happen. And then if that 5-day moving average, like what I would want to do is be long over here, but with a stop. That's the most important part. Be long over here as it gets back above that flat to rising 5-day moving average that might look like this. To get long in this area with a stop under here, and then keep raising that stop underneath the higher lows and getting stopped out when it makes a lower low. That's the way I look at these markets. It's not one dimensional, it's not one time frame, and it's certainly not something that I sketch in that I view as a potential scenario. That's all it is. So maybe that occurs in the S&P 500. Stranger things have happened, but we do have a declining 20 and 50-day moving average. That makes it suspicious. So when we have that, it also tells me that if I get long over here, it's not going to be with full position size because the 20 and the 50-day moving average are declining, and levels of interest again are 200-day moving average, year-to-date anchored VWAP from the March low. These are, or I'm sorry, from the prior low. The point is though that these levels are just that. They're just levels of interest. Support is only known after the fact once it's bounced. We had the potential for buyers to take control over here in the S&P 500 at the 200-day moving average, but it never got to a point where it made a higher high and higher low with a flat to rising 5-day moving average. So the market trapped people in here just like it did at this level, and then it kicked the shit out of them. The NASDAQ got a little bit of a bounce today, so I'm sure people are talking about the relative strength of the NASDAQ the way it did the Russell 2000 yesterday. Relative strength when you're in a downtrend just means you're losing less money. It's not a reason to become bullish. When you have a downtrend, that's the fact. You have a downtrend. A downtrend is comprised of lower highs and lower lows. Mathematically, when you're a downtrend, there's more opportunity to make money on the short side than there is the long side. The market drops 5 points, rallies 3 points. The market drops 4 points and rallies $3.75. The bottom line is the sum of the declines is greater than the sum of the rallies in a downtrend. And while we have a 5-day moving average that's declining, it's still guilty till proven innocent. Some people might say, hey, but it made a higher high today, a higher low today. And maybe it makes a higher high on Monday. Maybe it does this. But I would expect that it's more likely to fail because that 5-day moving average is still declining. So going into next week early, we've got the sellers still in control. The Russell 2000 undercut the 2022 low at 162.50. On Twitter, I had mentioned, hey, a lot of times we see that a market will undercut an important low, and after a large decline like we've just seen, that's often a place where stops get hit, uneducated short sellers come in, and then we see a bounce. So I had mentioned that, and looking to the shorter term time frame, let's look at the 5-minute time frame. I said what it needs to do is to hold above the volume weighted average price for the day and from the low. I got long in here, but guess what? I got out over here because I wasn't going to hold into this mess. That was the opportunity for the shortest time frame to turn positive. I also knew that because it's got a declining 5-day moving average, I was only going to make it a day trade, and it was smaller share size. If it had rallied real nice and done something like this, maybe I would have held partial into next week, thinking that, hey, maybe that was the real low. But that's all irrelevant, because what did happen is I got long in here, I took a little bit off on the way down, I got out of the balance over here, and I avoided that. Defense is what you need to play the strong. Defense wins championships, as they say. It doesn't matter if it's undercutting stops, whatever the point is. We've still got a level that, yeah, it was a big level of resistance previously and has been support over the last year. We're down to the anchored volume weighted average price from the 2016 low right here. That's that blue line. So a lot of things say there's a lot of price memory here, and where there's often price memory after decline, that tends to become support. But again, where's the evidence? It's simply not there. This is your guide. The direction of the 5-day moving average is lower. You've heard me say it ad nauseum, but it's how I look at these markets and how it saved me so much money from being the person who buys the dips. As I always say, don't buy the dip. Buying the dip is stupid. You're not running $1 billion fund where you have to buy $100 million worth of a stock, and you have to support that stock. You have to buy it on the way down. You can't wait for the momentum to turn higher. In a case like this with semiconductors, we can buy here. Let's say you're going to buy 10,000 shares, 50,000 shares. You can do that over here. Someone who has to buy 1 million shares, they have to buy and pull back. Let them do the dirty work and let them buy the dip and establish whether support will or will not be found at that 200-day moving average and year-to-date anchored VWAP, which so far, people will look at it and say, hey, it held. We don't know that it held yet. That's just one day, one day away from that low. What we need is we need to see a pattern of higher highs and higher lows above a flat to rising 5-day moving average. Next Monday, we get rid of this. Tuesday, we get rid of that. Meaning, if the market is up here on Monday, then we'll see a flattened out 5-day moving average. So what's more likely is maybe we do some of this stuff, and then on Wednesday of next week, when we get rid of this data, then we get above that 5-day moving average, and guess what? The 5-day moving average, after about this point, would start to rise once again. That's where I would become bullish. I don't need to buy right here, because every time I try to buy right here, it means I tried to buy here, tried to buy here, or all of these places. Let the institutions do the dirty work. Our job is to wait patiently for the buyers to take control of the shorter term trend, size it appropriately for the conditions we're in with a declining 20 and 50-day moving average, and then see what the market gives us. Manage the position according to what the market's saying. Biotechs continue to do, this has been my line for a while, biotechs continue to do what they do best, which is to destroy wealth and go lower. We closed just off the lows. 64.05 was the low today. We're 9 pennies above that level. There's no value in these stocks. There's no reason to buy the dip. People who buy the dips get what they deserve. I honestly believe that you deserve to lose your money if you buy the dip. Even for a longer term investor, you could be looking at it saying, well, I'm just early on this. You're early, but you don't need to be early. If you look at the weekly chart, it's just a disaster. We've seen all year, we've seen these lower highs 3 times in the last year and a half, and then we finally broke support. Not a surprise. I would not be surprised if we head down towards this low right over here and towards this, what is this level down here? I wouldn't be surprised to see it drop down towards about that 61 level. Anyone who is surprised by that doesn't understand the way trends work. Financial stocks broke down further here. Not a surprise. They're below a declining 5-day moving average. They're below a declining 20 and 50-day moving average. We broke this little platform and completely fell apart right down to the level where we're supposed to fall to. Now, does that mean we're going to bounce it? Perhaps we get a little bit of a bounce. I certainly wouldn't trust it. Maybe it does this, and maybe it turns around this time. But wait, let's just wait for evidence. There's no reason to be early. There was so much damage across the board in the markets this week. Energy names right back down to where they bounced previously, that year-to-date anchored VWAP 200-day moving average. All year I've been hearing people talk about the bull market in energy. And energy year-to-date, energy stocks, the XLE, where was that? Down 3.1%. That's not a bull market. We got a very choppy market in here. That's all that is. A bunch of nonsense. If you're trading on these shorter term time frames, then you can make sense of it. But to try to put money at work and hold that stuff, there were so many disasters this week. Let's look at a couple of them. ALGN. It was in a downtrend previously, and then they reported earnings, and news and surprises tend to follow the direction of the trend. ALSN, I don't know what this one is, ALSN, if I could type it right, but it just got destroyed. Amazon. Is that a bullish stock? No. To me, it's a bounce within a downtrend, right up to the 20-day moving average, the 50-day moving average just above, and you've got the anchor from this low over here. I don't think that it's ready for big upside. Charter, look how quickly these things fall apart from 460 down to 370, down 90 points. CHX, Champion X, just a disaster. Ford, look at this one. Found on the road dead. Here we can see, look at the weekly chart. Just a disaster. Look at this major level of support that was broken here. Terrible stock to own for the last 3 years easily. It's just been a disaster. There's no reason to own them because they're a brand name or whatever. Google got hit hard. It was in a nice uptrend. Earnings railroaded that. Always be aware of when earnings are due. IGT. MasterCard, this one was in a big uptrend, right? And then it just got destroyed. Risk management is job number one. We saw good numbers. I think we saw good numbers. We saw an initial good response to Microsoft, but it failed. And right from that open, it stayed below that volume weighted average price. And today we touched that volume weighted average price again from the earnings report. And guess what? Sellers showed up. So this rally, the better move would have been to wait for the undercut of the volume weighted average price from this low and then get short under here. That's the way these things, this looks like a failed breakout. From failed moves come fast moves. I'm not interested in buying these types of stocks. I'm not interested in buying NVIDIA. The only thing that's positive about NVIDIA is everyone is talking about this head and shoulders pattern. And when most people are talking about a head and shoulders pattern, you tend to see something like this. It undercuts there for a couple days and then squeezes them. I'm not saying that's going to happen. I'm just going to leave the stock alone. How about PayPal? How many times have you heard me make fun of this stock and make fun of the people buying in a downtrend? It's not that I'm trying to be mean and make fun of people, but the bottom line is it continues to show a pattern of lower highs and lower lows below a declining 40-week, 200-day moving average. It should not surprise you when PayPal does this, or when Square drops down to new lows, or Western Digital falls apart, or Weight Watchers. The list goes on and on and on. There's a lot of risk in this market. Wait for actual evidence that the buyers are gaining control with that 5-day moving average, and then determine what's the direction on the larger time frame. Is it in alignment? And then if it's not, well, then you look at your position sizing. These are the things that I write about in my books. If the concepts aren't clear to you, I suggest you buy those. If you want this type of analysis every single day with detailed explanations of not only the market but individual stocks, then take a trial at alphatrends.net. Have a good weekend.